Welcome to this video, where we dive into passive investing and break down the differences between two popular investment options, index funds and ETFs, exchange traded funds. While both of these vehicles track major market indices like the Nifty or Sensex, they each other offer unique features and benefits. So, how do you choose between the two? Should you go for the convenience and simplicity of index funds or the flexibility and low expense ratio of ETFs? By the end of this video, you will have a clear understanding of which one suits your investing style and financial goals. Passive investing is rapidly gaining traction among Indian investors, and the financial industry is evolving to meet this growing demand with an expanding array of options. Passive investing is a strategy where investors try to match the performance of a market index like the Nifty or S&P 500 rather than outperforming it by picking stocks. This involves investing in a diverse range of assets which reduces the need for constant trading and decision making. It typically has a lower cost since there is no active management. In the world of equity markets, you have two primary routes for passive investing: mutual funds, particularly index funds or exchange traded funds ETFs. Both of these tools mirror popular indices like Nifty or the Sensex. There are two ways by which passive investing is done in the equity markets. You can either invest by a mutual fund, more specifically a index fund, or alternatively, you can purchase an ETF. Both these instruments essentially mirror an index like the Nifty or the Sensex, but your options need not to be restricted to only the broader indices. For instance, today there are ETFs for gold, commodities, banks, healthcare, CPSE, Bharat 22, and now there is an increasing interest in factor-based ETFs like low volatility and value as well as international ETFs. Index funds and ETFs have a lot in common, including the fact that both products offer adequate diversification across tens, hundreds, and even thousands of securities, a low expense ratio, and of course, a potential strong long term returns. Index funds are passively managed instruments, but that's necessarily not the case with ETFs because ETFs can be passively managed or can be actively managed. In fact, as it's about 20% of ETFs in the United States are actively managed, which means that there is an investment team that is researching companies and taking decision on the ETF's portfolio allocation. These active ETFs can be really innovative in the construct. For example, an ETF can be built to track what popular investors like Warren Buffett or Rakesh Jhunjhunwala are investing in by simply cloning their respective portfolios. Index funds and ETFs have much in common. Both products offer adequate diversification across tens, hundreds, or even thousands of securities, features of low expense ratio, and provide the potential for strong long-term returns. This video will focus on understanding the difference between these two financial products. They will also explore the scenarios where one might be better suited than the other. Index funds are passively managed instruments, but that's not necessarily the case with ETFs. ETFs can be passively managed or actively managed. In fact, about 20% of ETFs in the United States are actively managed, meaning an investment team researches company and decides on the ETF's portfolio allocation. Active ETFs can be quite innovative. For instance, some ETFs track what popular investors like Warren Buffett or Rakesh Jhunjhunwala are investing by replicating their portfolios. Another example is the ARK Innovation ETF by Cathie Wood, which focuses on the disruptive innovation, including investments in DNA technology firms, industrial innovators, health tech, and next-gen internet companies. From an operational perspective, an index fund functions as a mutual fund, while an ETF is closer to how a stock works. ETFs, much like stocks, can be traded throughout the day at prices that fluctuate. In contrast, index funds can only be bought or sold at the end of the day price. While this may not concern long-term investors, those looking to time the market might prefer ETFs for the features like intraday trading, stop loss orders, and order limits. Additionally, ETFs require a trading and demat account, whereas purchasing an index fund is more straightforward and convenient when using apps like ET Money. When investing in ETFs, purchases are made in units such as 1, 7, or 100 units. In contrast, index funds are typically bought in terms of an amount such as rupees 500 or rupees 1000. This unit versus amount context influences the minimum investment required. ETFs often allow investors to buy a single unit, which can be as low as rupees 40, while most index funds require a minimum investment of rupees 100 or more depending on the AMC. Both index funds and ETFs are known for their low expense ratios. Through ETFs are generally cheaper. For example, the HDFC Nifty 50 ETF has the expense ratio of 0.05%, while the HDFC Nifty 50 index fund has an expense ratio of 0.20%. However, ETF investors should consider additional costs such as broker commission and bid-ask spreads, which can influence the overall expense of trading ETFs. Liquidity can be a concern with ETFs, especially in India, where certain sectoral of smart beta ETFs have low trading volumes. In contrast, index funds face no such issues as transactions are handled directly by the AMC, ensuring seamless liquidity. SIPs are widely available for the index funds, making them a disciplined and steady way for investors to participate in the equity markets. However, SIP options for ETFs are limited, though some platforms are beginning to introduce this facility. While index funds are entirely passive, ETFs can also be active. ETFs operate like stocks and offer intraday trading, whereas index funds are structured as mutual funds. The minimum investment for ETFs is unit-based, while index funds require amount-based investments. ETFs generally have lower expense ratio but come with additional costs like brokerage fee and bid-ask spreads. Liquidity is more straightforward with index funds, and SIPs are more accessible with them than with ETFs. Choosing between your index fund and ETF depends on your investment goals and style. Long-term investors seeking discipline and simplicity might prefer index fund, especially via SIPs. On the other hand, tactical investors who capitalize on market volatility may find ETFs more appealing. ETFs can also be used strategically for short-term market dips or to invest in undervalued sectors. Both index funds and ETFs are powerful tools in investors' arsenal. Index funds serve well as a core holding for long-term wealth building, while ETFs can be tactically deployed for short-term opportunities. As always, mutual fund investments are subject to market risk, and it's essential to read all scheme-related documents carefully.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high-performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.